Let's dig deeper with Komal Srikumar, president at Srikumar Global Strategies. Sri, let's talk about exactly what we saw here with the treasuries this week. I mean, what's your take? You heard Peter. He's sort of gloomy. He's waiting for people to realize that the earnings picture is crumbling. Things are not necessarily as great as they are. Where are you on this?
I approach the market from a more top-down perspective, and I think I come to a very similar conclusion as Peter had. My expectation is with the 2 to 10-year yield curve being so inverted, Eamon, and it has been inverted today to the extent of 90 basis points. The 3-month to 10-year has also been inverted. They have been inverted for months. The 2 to 10 started in early July. They are forecasting a recession. Today, the ISM...
Sri, can I interrupt you for a second? Because we talk about the 2 and 10-year and inverted yield curves all the time. I think there's some viewers out there who might not know what that means, and especially at 6 o'clock on a Friday night. So let's break that down. Explain what that is. Give us some market intelligence that we can use here.
Happy to do so, Eamon. Normally, the 2-year yield should be much lower than the 10-year yield because when you want to lend money to Uncle Sam, you want to be paid more for the longer time than you want to be paid for a shorter period of time. Inversion is when that process gets reversed and the US Treasury has to pay you more to borrow in the short term than in the long term. The reason is 2 or 3-fold. One, the short-term yield remaining so high suggests to you that the Fed is likely to create an error in terms of too much tightening going to cause a recession. The 10-year yield is low because a lot of people take refuge in the long-dated Treasury, and they think with the recession coming, they are going to get a lot of benefit as the yield goes down further. Those are 2 reasons. Third, the reason the 2 to 10 yield curve inversion is important is because banks borrow in the short term and they lend to you and me in the long term. And if the long-term yield is going to be lower than the short term, there is going to be a disincentive. Bank lending goes down. That also prompts a recession. So there are various reasons for doing that. They're all present today.
Bottom line, that's a signal a recession is somewhere on the horizon. Mike, go ahead, jump in. I know you've got some questions too.
Yeah, Sri, I guess from an investor's perspective, where does that leave you with regard to the attractiveness or unattractiveness of bonds of various sorts? Because there has been a rush of interest, obviously, people wanting to capture these higher yields because they obviously haven't been seen in years. Is that a trap or is that an opportunity?
It is an opportunity. It is not a trap. It basically tells you that if you are still sitting in low-yielding bank deposits, the banks get the benefit of your being there, but you are not benefiting at all. You get a benefit when you go into 6-month Treasury bills, and today you're earning 5.13% just for lending for 6 months without any risk. If you have waiting for the equity market to correct, and I think it is going to correct significantly, then it will be time to jump in. 6 months is a good opportunity. If, on the other hand, if you want to return to a 60-40 time portfolio, namely 60% in equities, 40% in fixed income, try getting the 2-year treasuries where you can get a very good yield, almost approaching 4%. And finally, if you're afraid of a recession, go get the 10-year yielding 10-year treasury. All of that says, Mike, that equities are a losing proposition today. And until you see the valuations come down significantly, just don't trust today's rally. It doesn't mean anything to me. And final point here, are equities a good predictor of a recession and therefore equity rally says to you that the economy is strong? Go back to October 2007. The S&P 500 reached an all-time record high. And I wrote a report saying we are on the verge of a recession based on what the bond market was telling me. The Great Recession began 2 months later, when 2 months earlier, equities were at an all-time high. Go figure, as they say.
Sri, thanks so much. My takeaway from that is don't believe the hype. You know, this is a rally in the short term, but you see a recession in the long term. I appreciate your insights here. Mike,
absolutely.
Also, thank you for your expertise.
You said